Okay, let's dive in. If you're an Australian homeowner, you've probably thought about refinancing your home loan at some point.
Absolutely. You see those low rates advertised everywhere.
Yeah, but then you maybe feel, well, a bit uncertain. Is it really worth all the hassle? Will the fees just eat up any savings you might make?
Or is that super low rate just, too good to be true? Definitely feels like a maze sometimes, all the conflicting info out there.
Mm-hmm.
And that uncertainty, it often comes from some really common myths. It means loads of Australians are paying more on their mortgage than they actually need to every single month.
Right, and that's exactly why we're doing this deep dive today. We want to cut through that noise surrounding Australian home loan refinancing. We're pulling out the key facts, the reality checks. The mission is simple, really. Debunk the biggest myths, give you the actual facts.
Yeah, so you can make decisions based on, well, reality, not just old fears or assumptions.
Exactly. And let's start with a big one that stops a lot of people right away. The idea that refinancing just costs too much up front.
Ah, yes, the fees.
You look at potential costs, application fees, maybe exit fees from your current lender, sometimes even lender's mortgage insurance, again, if your equity isn't quite there.
And it can feel like a pretty big hurdle. And look, there are upfront costs, that's true, usually somewhere between, say, a few $100s up to maybe a few thousand.
Okay.
But, and this is the crucial bit, those costs are often, tiny compared to the potential long-term savings. It's better to think of it as an investment.
Okay, like that example you mentioned. A $400,000 loan, right? If you drop your interest rate by just 0.5%,
Yep, just 0.5%.
that saves you around $125 a month, straight away.
Which is, what, $1,500 a year?
Exactly. And over 30 years, you're suddenly looking at savings of roughly $45,000.
$45,000. So when you see it like that, paying $500 or even, say, $3,000 in fees up front, it doesn't seem quite so scary anymore.
It puts it in perspective. And there's a way to figure out when you actually start saving, right?
There is. It's a really simple calculation, the break-even point. You just take your total upfront costs. Okay.
And divide them by how much you'll save each month. That number tells you exactly how many months it takes until those savings kick in. And you're officially ahead. You're in the money saving zone.
Got it. So yeah, refinancing does cost money up front, but like the quote says, it can save you way more in the long run.
Precisely.
Doing that quick bit of math yourself seems absolutely vital then, so you can see if it stacks up for your situation based on how long you think you'll keep the loan.
Couldn't agree more. Okay, now let's tackle another common trap. That's assuming the loan with the absolute rock-bottom advertised rate is always the best deal.
The headline rate. Everyone sees that first.
Of course. But it's hardly ever the full story. That lowest rate often isn't the cheapest overall loan once you factor in all the fees.
Right, the other costs.
And just as importantly, the loan features. Now, the comparison rate helps a bit. It's supposed to include some standard fees.
But it's based on a hypothetical loan, isn't it? Exactly. It's just a guide. You still need to look closely at all the fees, monthly fees, annual fees, setup fees, but also don't forget the features.
Okay, features. Why are they so critical?
Well, because things like an offset account, where your savings work to reduce your loan balance for interest calculation.
Yeah, those are great.
Or a redraw facility, letting you pull back extra payments if you need to. Or maybe the flexibility to make extra repayments without being penalized. These things can save you a fortune in interest over time.
Or just give you vital flexibility when life happens.
Absolutely. So sometimes a loan with a slightly higher interest rate, but maybe lower ongoing fees or really valuable features like an offset account could actually be the much better deal for you overall.
Right. It means you need to look beyond that flashy number. Like the quote says, the best loan isn't always the one with the lowest rate. It's the one that works best for you and saves you the most money overall.
That sums it up perfectly. It really shifts how you should be comparing your options.
Okay, let's hit one more major myth. This fear that if you refinance, you automatically have to restart your loan term right back at 30 years.
Oh yeah, that's a big one. People think, I've been paying this off for 5 years, I don't want to go back to square one.
Feels like going backwards, doesn't
It
it?
does, but it's not true. As simple as that. You get to choose the length of your new loan term. You have control.
So you could match what you have left. Like if you have 22 years left, you take a 22-year term.
Exactly. Or you could even choose a shorter term, say 20 years, to pay it off even faster. Or yes, you can choose to restart at 30 years if lowering the monthly payment is your main goal right now.
Okay.
Yeah.
But there's a big trade-off there, isn't there?
A huge one.
What?
Restarting at 30 years will generally lower your minimum monthly repayment, which helps with cash flow. But you end up paying significantly more interest over the entire life of the loan. Tens of thousands more, potentially.
Whereas keeping the same term or even shortening it, that's where the big interest savings are.
That's right. That example was pretty powerful. Shortening a $600,000 loan from 25 years down to 24 years, it saved over $26,000 in interest.
Wow. And the monthly payment only went up by about $70.
Yeah, incredible difference long term for a relatively small change month to month. That quote nails it. Nope, you don't have to start from scratch. You can choose the length of your new loan.
It really underlines the control you have in the process. And a smart tip is, even if your new minimum payment drops after refinancing, you could just keep paying the old, higher amount anyway. That way you build equity faster and pay the whole thing off sooner.
That's a fantastic strategy. So look, we've just touched on a few really key myths today, tackling the fear of costs, looking beyond just the lowest rate, and clearing up the confusion about loan terms.
But the article itself covers even more, doesn't it? Things like needing exactly 20% equity, or the risks of debt consolidation, or whether approval is ever truly guaranteed.
It does. It dives deeper into the examples, the steps, the specific calculations. Reading the full piece gives you that complete picture, that roadmap you need to feel really confident.
It gives you the practical details to actually act on these realities. So maybe a question for you listening. Based on these realities we've discussed, are your current assumptions about refinancing perhaps holding you back?
Yeah, or could running a quick calculation, that break-even check, reveal potentially thousands in savings that you're missing out on right now?
Maybe the biggest myth of all is just assuming that staying put, doing nothing, is always the easiest or cheapest option.
That's a provocative thought. Sometimes taking informed action based on the facts, not fears, is really the path to better financial well-being.
And just a final note for our Australian expat listeners. We know refinancing can have some unique complexities when you're living overseas. For tailored guidance and support designed specifically for your situation, Odin Mortgage does offer strategy sessions to help you navigate that and potentially unlock savings and peace of mind.